Hello everyone. Welcome to the course on International Financial Management. If you recall from previous lectures, we have discussed the difference between transaction, translation, and economic exposure. We got an idea of what is economic exposure. We have already covered transaction exposure and translation exposure in details. Today we are going to complete the trilogy by studying the third and in many ways the most complex and far reaching type of foreign exchange exposure, which is called economic exposure. In simple words, economic exposure, sometimes also called as operating exposure, refers to the measure of the change in future cash flows of a company as a result of unexpected changes in forex rates. Now, let me start with an example of a domestic business. Let's assume that there is a bicycle company in India. We'll call it Bharat Cycles. Everything they do is inside India. They buy steel from India, they make bicycles in India, they pay their workers in rupees. They sell only to Indian customers. So there is no foreign exchange, no dollars, no import, no exports, nothing foreign. So tell me, does this company has any foreign exchange risk? Most people will say no. But the answer is yes. And that's the whole point of today's class. Here's why. Suppose a Chinese company is also selling bicycles in India. Now, when the Chinese yuan becomes weaker against the rupee, that Chinese bicycle becomes cheaper in India. The Indian customer sees a cheaper option and stop buying from the Bharat Cycles. Now, what has happened to Bharat Cycles? It has lost its business. Their product didn't change, their price didn't change, their workers didn't change. Only a currency changed. Somewhere far away. In a country they don't even do business with. That is forex risk. It doesn't always come through your own transactions or your own translation risk. Sometimes it comes through your competition. Bharat Cycles competes in Indian market against imported bicycles from China, Taiwan, and increasingly from European brands. Domestic consumers will compare price, quality, and features, and the price of that imported bicycle is determined not just by what it cost to make in China, but also by the exchange rate between Chinese yuan and Indian rupee. When the Indian rupee strengthens against Chinese yuan, imported Chinese bicycles become cheaper in rupee terms for Indian consumers. Bharat Cycle has not a single thing changed. But Bharat Cycles loses its customers to cheaper cycles sold by Chinese company. This is economic exposure, also called as an operating exposure. It is the risk that exchange rate movement affect a company's revenue and competitive position even when the company itself does zero business in foreign currency. Now let's go deeper into this example. Let's first set the baseline. By assuming the initial exchange rate to be 11 rupees per Chinese yuan, a Chinese company sells the bicycle in the retail in India at around 11,000 rupees. Bharat Cycle sells its bike at 11,500 rupees, just 500 rupees more, a gap of about 4.5%. Customer happily pay a small premium for a domestic brand, services, etc. Or maybe Bharat Cycles have some important features. Bharat Cycle is competitive here. Now, what is the cost of Chinese bicycle here? 800. And what is the retail price when it is exported to India, which is 1000? That means 200 goes for custom duties or transportations and everything. So Chinese bicycles price is 1000 yuan in India. When it is 1 Chinese yuan is equal to rupees 11, so it becomes 11,000, and Bharat cycle is at 11, selling at 11,500. So here there is only a premium of 500 for Bharat cycles over imported cycles. Now suppose the rupee appreciates from 11 rupee per yuan to just 9 rupee per yuan. That's an 18% strengthening. Bharat cycle has done nothing different. Same factory, same worker, same price. That is 11,500. But the Chinese bicycle, it's now only 9,000 rupees in India. The price is same while the exchange rate has changed, and now it is 9 rupees per yuan. So if you consider, you converted the cost of the or the price of the Chinese bicycle in India becomes 9,000 rupees, while that of Bharat cycles remains the same, which is 11,500. Now you can see the difference has increased so much. Now it is 2,500. Price gap has jumped from 500 rupees to 2,500 rupees. What was a 4.5 premium is now a 28% premium. At that gap, price sensitive customers, especially in tier 2 and tier 3 cities, start switching to the Chinese bike. Sales fall, revenue fall, profits fall, and Bharat cycles never even touched a foreign currency. Now, the key characteristics of economic exposure. First, long term in nature. Unlike transaction exposure, which arises from a specific contract and is resolved when that contract is settled, perhaps in 30 days or 90 days, economic exposure can persist for years. It stays with the company for as long as they operate in a competitive marketplace influenced by global exchange rates. Second, it is not contract specific. Transaction exposure is tied to a specific invoice or a financial contract. Economic exposure, by contrast, arises from business operations as a whole. It is a broader, more strategic risk. Third, it is subjective. Measuring economic exposure requires forecasting future cash flows and estimating their sensitivity to exchange rate movements. It involves assumption, judgment, and forecasting, which introduces subjectivity. Two analysts looking at the same company might produce different estimates of economic exposure. Now, fourth, it is hard to hedge perfectly. Economic exposure requires operating changes, changing in sourcing of the raw material, the pricing strategy of the product, the production location, the manufacturing unit location, not just financial instruments. This makes perfect hedging very difficult. Fifth, dynamic. Economic exposure is not static. It changes as the firm's cost structure, pricing power, and competitive landscape evolve. A company that was once highly exposed may reduce its exposure by diversifying its supplier base or its customer geography, and vice versa. Now, let's take another very good case study. Let's talk about Indus Grand Hotel. Now, let's talk about its setup first. Indus Grand Hotels is a mid-sized Indian hotel chain which is operating luxurious properties in Goa, Kerala, Rajasthan, three of the most popular international tourist destinations. The business was built on a simple and historical sound premises. When the Indian rupee is weak against major foreign currencies, India becomes an affordable luxury destination for European and British tourists. A five-star experience in Goa cost a fraction of what the same experience cost in Maldives, Bali, or any Mediterranean country. The company earns all its revenue in Indian rupees. There is not a single foreign currency receivables on the company's book. Now, to fund a major expansion, the management takes a dollar denominated external commercial borrowing from an overseas bank at 6% per annum, cheaper than the 10% available from Indian banks at that time. Additionally, the hotel signs long term contracts with the International Hospitality Management Company for brand licensing and operational support payable in dollars quarterly. Now, here it has exposed itself to foreign currency risk. It has taken a USD loan of 20 million from overseas bank, and it is also paying USD 1.5 million per year for branding licensing. Now, on paper, the finance team believes they have no currency exchange exposure. After all, they collect rupees from every guest. They are wrong. There are various economic exposure or foreign exchange exposure from different channels. Now let's talk about these channels. First is the revenue channel, which is a demand exposure. The volume of foreign tourists and therefore the hotel occupancy rate and revenue is directly driven by how expensive India appears to the European and British tourist. The perception is determined by the exchange rate of euro per Indian rupee and British pound per Indian rupee exchange rates. When the rupee weakens, India looks cheap and attractive. When the rupee strengthens, India loses its price advantage. Again, competing destinations like Thailand, Turkey, or Portugal. Now, the second channel which is exposed is the cost and debt side, which is the liability exposure. The dollar loan repayment and the management fee contract both become more expensive in rupees term whenever the rupee weakens against the dollar. The cruel irony, and this is the key teaching insight, it is that the two channels can move in an opposite direction at the same time. The rupee can strengthen against the euro and can hurt revenues, while simultaneously the dollar can weaken against rupee and can hurt the cost. The hotel gets hit from both sides at once, that is from the demand side or the revenue side and also from the cost side. Now let's talk about this. We have the rooms across all properties are 500. Occupancy rate is 80% per night. That means 80% of 500 becomes 400 rooms. And these 400 rooms, when multiplied by 365, that means we are able to let 1,46,000 rooms per annum. Now, here is the income statement given. Now, if we know that the room rate per night is 15,000, when we multiply 1,46,000 with this 15,000, we get a revenue of 219 crores. Apart from that, we are also earning 81 crores. Now, from where this 81 crore is coming? It is coming from food and beverages. The total revenue, if we add these two, comes out to be 300 crore. Now, we have an operating cost, the cost of wages and other things, which is 180. And when we take the dollar obligations also, we subtract the dollar obligations. So, how much dollar obligations we have? We have a total dollar obligations of 2.7 million USD dollar. Now, this 2.7 million USD dollar, it consists of the loan that we have taken in USD as well as the management fee that we are giving for branding and licensing. So, if we convert this 2.7 million USD dollar at a rate of 83 per dollar, we get 22.4 crore. Now, what do we have to do? We have to subtract 180 and 22.4 crore from this revenue figure and we get the profit, which is 97.6 crore. Now, let's see the exchange rate base that we have started. It is going to be used later. It is 83 rupees per dollar and 89 rupees per euro and 105 rupees per British pound. So, here we are getting tourists from the Eurozone country. We are also getting tourists from Britain and maybe from US also. And now the rate has changed. It can be also, since single currency movements are really rare, there can be various currency movements. And here, suppose over the 2 years, the euro INR moves from 89 to 75. That means rupee strengthens 16% versus euro. And the British pound per INR moves from 105 to 88. Here also the rupee strengthens as 16% vis-a-vis pounds, while USD INR moves from 83 to 91. Here the rupee weakens, that is 10% with dollar. Now here we can see this. Here the rupee is strengthening. It was 89 per euro, now it is 75 per euro. Here again the rupee is strengthening. It was 105 per euro and now it is 88 per euro. Here it is becoming opposite. Now what is the opposite part here? The rupee is weakening. It was 83 per dollar and now it is 91 per dollar. Now that was the most dangerous scenario, and hence let us see what is going to be the impact on that particular scenario. What previously cost a British tourist pound 143 per night now cost pound 170 per night. A 19% increase in pound sterling terms without the hotel raising its rupee price by a single rupee. India has become visibly more expensive relative to the competing destinations. Now, India has gone from the cheapest option to the most expensive option. European and British booking fall. Assume occupancy drops from 80% to 60% as foreign tourists divert to Turkey, Thailand, and Portugal. The hotel didn't change its price. It did not reduce its service quality. It simply became expensive in the eyes of core foreign customers base because of the currency movement it had no control over. And the revenue dropped by 67 crore. Now we can see here the occupancy rate is now 62%. So this was the 80% figure and now this is our 62% figure because it has dropped by 18%. There is no change in the room rate. It is same 15,000. While if we multiply 15,000 with 1,13,300, the room revenue, the total room revenue has changed and this is 170 crore. So earlier it was 290 crore. So the revenue has gone down. But here there is another thing, that is the other revenue, which is the food and beverages. They have also gone down because less number of people are coming, so hence less is going to be the sales for food, beverages and spa. Now what is our new figure? The new figure is 233 crore revenue, which has gone down by 67 crore. So we have made a loss of, there is a loss of 67 crore. Now let's see the impact on cost. Earlier we saw the revenue side and now we are going to see in the cost side. Right? Now here we have an interest 1.2 million. This is what we have to pay every year in USD. We have a management fee which is 1.5 million. This is what we have to pay every year. So the total dollar obligation is 2.7 million. Now if we convert it at 83 rate, the total cost comes out to be 22.4 crore in rupees. But if we convert it at 91 rupee rate, because the rupee has depreciated, now what is going to be the cost? The cost has now increased to 24.6 crore rupees. That means how much increase is in the cost? Because of the depreciation of rupees vis-a-vis dollar, it is 2.2 crore. And this is what? The increase in the cost. Now what we are going to do? We are going to find the profit. When we were considering the base case, it was 300 crore, and after currency shift it is 233 crore. That means it is down by how much? 67 crore. Now the operating cost was 180 crore. Let's say 180 crore had mostly the the variable cost, and the variable cost fell with the occupancy rate. So now the variable cost is also less, which is 160 crore. Our dollar obligation at the time of base rate was how much? 22.4 crore as given here, and now it is 24.6 crore as we have calculated here. Now let us consider the profit. We will subtract these two items from the revenue, and we get how much profit? 97.6 crore profit in the base period. And what is the profit here? The profit here is 48.4 crore, and this is the profit that we have got after considering the changes in the exchange rate. And this 48.5 crore is actually reduced. So our profit has declined by 50.47. And let me recapitulate that why it has reduced. It has reduced because the exchange rate has changed. And what were the changes in the exchange rate? We have already discussed. The changes in the exchange rate were rupee strengthened against euro, rupee strengthened against Great Britain, making the cost of staying expensive. And here the rupee weakened against USD dollar. So this led to the reduction in the profit. Now let us take an upside. Upside means it may not always be wrong, it may be favorable also sometimes. Now we will run with the same logic but in a reverse order. It is like in the earlier case we said that the rupee weakens against dollar. Now let us say the rupee weakens against euro, right? The rupee weakens against euro from 89 to 102. If you remember, in the previous case, rupee strengthened against the euro and it was from 89 to 75, right? That is why the demand for the room or went down, because the countries in the eurozone felt it was expensive. But when it goes down, then what happens? Now here the room cost for British tourists also went down, because rupee did not only weakened against the euro, it had weakened against the British tourist also, maybe in the weekend against the British pound also. So here now the cost of pound 143 per night has been reduced to pound 127 per night. Now this is the cost, right? The cost of what? The cost of room rent. Room rent has reduced. So now what has happened, that India is become cheaper. Now India has become cheaper. Since it has become cheaper, the occupancy rate has increased from where it earlier at the base rate, the occupancy rate was 80%. Now it has increased to 91%. This is the new occupancy rate, right? Now we have a same hotel, same room and same management. Now if we calculate the profit as we have done before, we will find that there is a gain of plus 29%. That means at the base rate the profit was 97.6 crore and now the profit is 125.5 crore. So there is a gain. Now here I would like to repeat that the rupee has weakened against euro also, as well as British pound. Fine. Now let us see this case. The occupancy rate was 80% at the base case. When things went unfavorable, when euro increased and USD reduced, it was 62%. 2% occupancy rate. When it was favorable, that means when the euro reduced as well as the British pound also reduced, the occupancy rate increased to 91%, leading to a very higher revenue, which is 341 crore, and also a very good profit figure, which is 125.5 crore. Now profit, now if you see the adverse case scenario and the best scenario that we have, the profit swings from 48 crore to 125 crore, and this is purely driven by exchange rate movements. The hotel has done nothing, it has not changed its operation. So we can see that what happens to a company when it is subject to economic exposure. Economic exposure can have serious negative consequences for a company's operations and profitability. Economic exposure is invisible on the balance sheet. Indus Grand Hotel has no foreign currency receivable, no import payable, nothing that shows up in the standard transaction exposure analysis. Yet, exchange rate movements can halve its profits or boost them by 30%. Economic exposure can undermine a company's competitive position. This is not a minor operational issue. It can fundamentally reshape an industry. This slide gives us a structural framework of understanding the channels through which economic exposure operates. At the top is firm value. This is ultimately what we are trying to understand and protect. Firm value is affected by two channels. Home currency value of assets and liabilities. This is what we call asset exposure. Second, future operating cash flows. This is a operating exposure. Both of these are impacted by exchange rate fluctuation. So when exchange rates move in unexpected ways, they affect both the value of what the firm owns and owe and the future cash flows that the firm expects to generate from its operations. Together, these constitute the full scope of economic exposure. Now, let us turn to the measurement of economic exposure. Formally, economic exposure is defined as the sensitivity of the future home currency value of the firm's asset, liabilities, and operating cash flows to random changes in exchange rates. There are two dimensions to measure: the sensitivity of the home currency value of the firm's assets and liabilities to random changes in exchange rates. This is the asset exposure component. Second is the sensitivity of the firm's operating cash flows to random changes in exchange rate. This is the operating exposure component. To measure these sensitivities statistically, we use regression analysis. Let's go into details. Here is the regression framework. Suppose a US multinational corporation has British assets. We want to quantify how sensitive the dollar value of these assets is to the movement in the dollar-pound exchange rate. We run a regression of the form: P is equal to A plus B into S plus E, where P is the dollar value of the British assets, S is the spot exchange rate expressed as dollars per pound, A is the regression constant, which is the intercept, E is the random error term with a mean of 0, and B is the regression coefficient. And this is the crucial term. The coefficient B measures the sensitivity of dollar value of assets to exchange rate S. This is the exposure coefficient. If B is positive, it means that when pound strengthens, that is S increases, the dollar value of the assets also rises significantly. Firm gains from pound appreciation. If B is negative, the firm's asset lose value when the pound strengthens. The regression is estimated using historical data, past values of P and S, to arrive at a best estimate of B. Now, the exposure coefficient B is defined from more precisely as B is equal to covariance between P and S divided by variance of S, where covariance of B and S is the covariance between the dollar value of the asset and the exchange rate, while variance of S is the variance of the exchange rate. This formula should look familiar from basic statistics. It is essentially the slope of the regression line in an ordinary least square regression. Intuitively, the ratio tells us for every 1 unit change in the exchange rate S, by how many units does the value of P exchange, that is the economic exposure. Looking at the formula again, B is equal to covariance of P and S divided by variance of S, we can identify two distinct sources of economic exposure. The variance of the exchange rate, that is variance S. This is the volatility of the exchange rate itself. Higher exchange rate volatility means greater potential for unexpected swings and therefore greater exposure. This is an external market driven factor that firms cannot control. Then second, the covariance between the asset value and the exchange rate, that is covariance P and S. This captures the degree to which the firm's asset values move in tandem with the exchange rate. A firm can influence this through its operating and financial decisions. For example, by diversifying the currency base of revenue or its assets. So, exposure is not just about how volatile the exchange rate is, it also depends on how tightly it is linked to the firm's asset value. Let us briefly list the key factors that determine how exchange rate changes translate into changes in firms' operating cash flows. The first is expected inflation rate differential. The difference in the interest rate between two countries affects the real purchasing power and thus real cash flows. Second is price elasticity of demand. How sensitive are your customers to price changes? If demand is elastic, even a small price change due to exchange rate movements can severely affect your volume. Third, differential features of the product. Unique differentiated products give firm more pricing power, reducing their sensitivity to exchange rates. Fourth, competitors. Now, who are your competitors and where are they based? This determines the competitive effects of the exchange rate moves. Fifth, availability of substitutes. More substitutes means more competition and greater sensitivity of demand to price changes. Sixth, ratio of imported input to total input. The higher the proportion of imported inputs, the more the firm's cost side is exposed to the exchange rate movements. These factors together determine the overall magnitude and direction of economic exposure for any specific firm. Now, let us systematically understand the sources of economic exposure, starting with the revenue side. Now, first are the export revenues. When the home currency appreciates, export prices in foreign market effectively rise in foreign currency terms. So, demand from the foreign buyers may fall, reducing export revenues. Second is the pricing power. Firms with strong brand or unique products have some ability to maintain their foreign currency prices even when the home currency appreciates, absorbing the exchange rate change within the price. Commodity firms, however, do not do this. They are price taker. Next is market share. If the domestic firm prices in its home currency and the foreign competitors' prices in their currency, an exchange rate shift can dramatically change the relative competitiveness of each firm's product, altering market share. Next is the volume effect. Beyond just the revenue per unit, exchange rate changes affect the quantity demanded. Here, the price elasticity of demand plays a crucial role. Now, the cost side. One is the imported raw material. If a firm buys inputs that are priced in foreign currency, appreciation of that foreign currency raises production cost. For example, An Indian textile manufacturer importing US cotton will find cost rising if the dollar appreciates. Next is foreign wages. For a multinational firm operating plants or offices in multiple countries, a shift in exchange rate changes. That is, the home currency equivalent wages cost in foreign location also changes. Next is foreign debt service. If a firm has borrowed in foreign currency, exchange rate movement affect the foreign home currency cost of repaying interest and principal. This is a very real cost side exposure for emerging market companies that borrow in USD or Euro. Fourth is competitors' cost. This is a subtler point. If your rivals source their inputs from countries with a weakening currency, their cost base fall. Even if your costs are unchanged, you are now at a competitive disadvantage. Your relative cost position has worsened. So, economic exposure permeates both the top and the bottom line of the firm's income statement. That's all for now. In this lecture, we learned in depth about economic exposure, discussed some of its practical examples, how we can measure economic exposure, and how its effect depend on pricing power, elasticity of demand, competitor structure, and input composition. We all learnt about the different sources of economic exposure, which were revenue side and the cost side. In our next lecture, we will explore how firms can manage and hedge economic exposure through various ways. Till then, bye for now.